What are the S&P 500 and Dow Jones? How do American markets shake the economy of the entire world? It is 8:30 at night. In India, a small investor is looking at his portfolio on his phone. The Indian market has closed by now, but his eyes are fixed on America, because the real fear begins now. As soon as the market opens in New York, red spreads across the screen. The S&P 500 drops, the Dow Jones breaks down, and within a few minutes, tension appears on the faces of investors worldwide. The question is not just about America. The fear is that if panic increases there, what will happen to the Sensex and Nifty in India tomorrow morning? Will the small investors' money shake too? Right from here, curiosity begins. After all, how did these two American names, the S&P 500 and Dow Jones, become so powerful that even their slightest movement begins to signal the global economy? The real story is that neither of these is a company, an exchange, or a government department. They are indices, meaning large thermometers that measure the health of the market. Just as a thermometer does not look at all the blood in the body to measure a fever, but simply tells the temperature, an index tells the market mood by looking at selected companies out of thousands of shares. In India, we hear about the Sensex and Nifty. The Sensex shows the movement of big companies on the BSE, and the Nifty explains market conditions through 50 big companies on the NSE. In America, this very role is played in different ways by the Dow Jones Industrial Average and the S&P 500. Both tell the story of the US market, but their language and perspective are different. The story of the Dow Jones is very old. It started in 1896 when journalist Charles Dow tried to make the market understandable for the common man. At that time, America was becoming an industrial power. Sectors like railroads, steel, sugar, tobacco, and manufacturing were the heartbeat of the economy. Dow thought that if a few big companies could be tracked, the mood of the economy could be understood. In the beginning, the Dow had only 12 industrial stocks. Times changed, companies changed, and today the Dow Jones Industrial Average is considered an index of 30 large US blue-chip companies. Blue-chip companies mean large, old, and financially strong companies whose identity in the market is built on trust and scale. You can think of the Dow as America's corporate VIP club. But the calculation of the Dow is a bit old and unique. It is a price-weighted index. This means that a company with a higher share price will have a greater impact on the Dow. Here, the share price matters more than the size. A company can be very large in market value, but if its share price is low, its impact on the Dow can be limited. This is both the strength and the weakness of the Dow. It is a strength because it is simple. It is a weakness because 30 companies cannot show the complete picture of the entire US economy. In June 2026, the announcement was made to include Alphabet in the Dow in place of Verizon. This change shows that the Dow is also leaning away from old industrial America toward an AI and tech-driven America. Now let's come to the S&P 500. Its full name is the Standard & Poor's 500. It is considered the most popular benchmark for modern investors to understand the health of America's large-cap market. The launch date of the S&P 500 is considered to be March 4, 1957. As the name suggests, it includes 500 leading publicly traded companies in America. It is not a club of just 30 names like the Dow. It includes large companies from technology, healthcare, finance, consumer goods, energy, industrials, and many other sectors. The S&P 500 is a market cap-weighted index. Market cap means the total market value of a company, which is the share price multiplied by total shares. The bigger the company, the more weight it carries. If big companies like Apple, Microsoft, Nvidia, or Amazon move, their impact on the S&P 500 can be seen clearly, because their market value is massive. This is the reason why the S&P 500 is considered a broader mirror of US large-cap equities. According to official data, it covers around 80% of the available US market capitalization. But remember one thing, the S&P 500 does not include every company in America. It is a basket of selected leading companies tied to criteria like liquidity, size, and market relevance. Now understand the difference between the Dow and the S&P 500 with a simple example. The Dow is like a small elite boardroom where 30 big companies are sitting. The S&P 500 is a large corporate stadium. The Dow tells you how a few old and powerful companies in America are doing. The S&P 500 tells you the overall mood of the broader US corporate market. The Dow appears more in the headlines because it has a long history and holds a significant emotional value in the media. However, professional investors often consider the S&P 500 a more comprehensive benchmark. Many index funds, ETFs, pension funds and global portfolios use the S&P 500 as a benchmark. Therefore, movement in it is linked not just to news but to actual money flows. Now the big question comes, why does an American index shake India or the rest of the world? The answer lies not just in the stock market, but in the structure of the global economy. America is one of the most influential economies in the world. Its companies earn global revenue, its consumer demand impacts global exporters, and its dollar is the backbone of international finance. According to a 2025 BIS survey, the US dollar was on one side of more than 89% of transactions in global foreign exchange trades. This means the dollar is not just America's currency, it is the global financial language. When the fear of interest rates, inflation, or recession increases in America, global investors begin to reduce risk. They can pull money out of emerging markets and shift into safer assets. Because of this, a big drop in the S&P 500 or the Dow does not just scare US investors. It signals that global risk appetite is weakening. Risk appetite means how much risk investors are willing to take. When confidence is strong, money comes into emerging markets like India. When fear grows, that same money can go back. In India, FPI and FII flows can affect the market mood. If foreign investors engage in heavy selling, pressure can come on the Sensex and Nifty, especially in large-cap stocks. The Nifty 50 itself is India's well-diversified 50 stock index and, according to official data, represents a large portion of the free float market capitalization of NSE-listed stocks. Therefore, when the US market falls at night, traders in India check global cues first thing the next morning. The opening mood is shaped by the GIFT Nifty, Asian markets, and US futures. But the global impact is not limited to stock prices. A major portion of revenue for many Indian IT companies comes from US clients. If there is a slowdown in America, outsourcing demand can be affected. Manufacturing exporters, pharma companies, and auto component makers can also be linked to US demand. Therefore, weakness in the American economy can have an indirect impact on Indian corporate earnings. If the dollar strengthens, pressure can come on the rupee. If the rupee weakens, imports can become expensive, especially items like crude oil, which can increase the risk of inflation. The bond market is also a part of this story. If US Treasury yields rise, global investors might see attractive returns in America. Then, the money flow into emerging markets can slow down. The policy of the Federal Reserve also becomes a global signal. If rates remain high in America, the dollar can stay strong. If hopes for a rate cut build up, optimism can return to risk assets. This is the reason why the S&P 500 is not just a chart of stocks. It becomes a combined signal of inflation, interest rates, company profits, consumer demand, and investor psychology. The movement of the Dow Jones is also symbolically powerful. If the Dow falls 500 or 1000 points, panic is more visible in news headlines, even if the percentage move tells a different story. There is a trap here as well. It is easy to get scared by looking at points. It is necessary to look at percentages. A 1000-point drop would have been massive in the old days, but today at a higher index level, its meaning can be different. There is a trap in the S&P 500 too. Because it is market cap weighted, a few mega-cap tech companies can pull the entire index up or down. Following the AI boom, the influence of tech companies in the US market has grown significantly. If a few large tech stocks fall, the broader index can look weak, even if other sectors are doing fine. This is why smart investors do not just look at the headline index. They also look at sector performance, the equal weight index, earnings trends, bond yields, and currency movements. The old industrial name of the Dow might even seem a bit misleading today because the modern Dow includes companies from technology, healthcare, finance, consumer, and other sectors. America's economy is also not what it was in 1896. Back then, factories and railroads were dominant. Today, software, cloud, AI, advertising, chips, and digital platforms have become economic powerhouses. Even so, the cultural value of the Dow has not diminished. It is the oldest popular symbol of the market. When people say the Dow fell, the general public immediately understands market panic. The S&P 500 holds more technical and institutional importance. Mutual funds, ETFs, retirement accounts, and global asset managers use it for performance comparison. The world's economy appears to dance because markets today are interconnected. One country's interest rate, another country's currency, a third country's exports, and a fourth country's stock market are all linked together. But it is also true that the American market is not a remote control. It gives signals, creates pressure, and changes confidence, but each country's domestic economy also remains important. In India, domestic mutual funds, SIP culture, retail investors, and the local growth story often reduce the impact of foreign selling. Therefore, every US fall does not mean an Indian crash. Still, ignoring US indices is not wise. For a small investor, they are like a global weather report. You don't stay home just by looking at the weather report, but you certainly keep an umbrella. If the S&P 500 is falling continuously, the Dow is weak, the dollar is strong, and bond yields are up, global investors can become cautious. This combination can bring volatility to India. If the S&P 500 is strong, corporate earnings are good, the Fed is giving soft signals, and the dollar is calm, the mood for global liquidity can be better. But an investment decision should not be taken simply by looking at these indices. A company's quality, valuation, debt, earnings, sector trends, and personal risk profile are equally important. The biggest mistake in the market is to panic upon seeing a headline. The news will say the Dow broke down, but you need to understand why the drop happened and what relation it has to your investment. Sometimes a drop is America-specific. Sometimes it is global. Sometimes only tech stocks fall. Sometimes banks, energy, or small caps come under pressure. Not every red screen tells the same story. Understanding the S&P 500 and Dow Jones is necessary because they teach the language of the market. They tell you which direction money is moving and where fear is growing. For a small Indian investor, this knowledge can become power. He can understand that a drop in his portfolio might not just be his company's problem, but could also be the impact of global sentiment. Today, money crosses borders in seconds. A fund manager takes a decision in New York, and its impact can be seen as far as Mumbai, Seoul, London, and Singapore. This is the invisible chain of modern finance. The Dow, S&P 500 dollar bond yields, crude oil, FPI flows, and local markets have all become chapters of the same global story. So next time you hear in the news that the S&P 500 is down or the Dow Jones is at a record high, do not think of it as just foreign news. Understand that it is a signal. Somewhere investors are taking risks, somewhere they are afraid, somewhere they are booking profits, and somewhere they are betting on future growth. The Dow Jones lets us hear the heartbeat of America's corporate history. The S&P 500 shows us the broader picture of the modern US market. Both are different, but the impact of both is global. And perhaps that is the biggest suspense of this story. You hold Indian shares in your Demat account, but their mood sometimes begins to be decided by the night in New York. Because today, the economy is no longer local. Your money might be invested in India, the company might bring revenue from America, the raw material might be global, and the investor sentiment might come from Wall Street. That is why the S&P 500 and Dow Jones are not just two American indices. They are two large indicators of global finance that show whether the world is afraid, greedy, or waiting for a new growth cycle.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.